Thank you everyone for joining us today as we dive into data center usage, especially as it relates to artificial intelligence. There's been a lot written about this recently, so we're excited to go deeper into the findings of our new report about this topic. My name is Susan Torres. I am currently the interim North America Communications Manager at IEEFA. The Institute for Energy Economics and Financial Analysis is a think tank that examines issues related to energy markets, trends, and policies. The Institute's mission is to accelerate the transition to a diverse, sustainable, and profitable energy economy. Today, Cathy Kunkel will be presenting the findings of her recent report about data usage in the southeastern United States. Cathy is an energy consultant at IEEFA, and she has also served as an IEEFA energy finance analyst for 7 years, researching Appalachian natural gas pipelines and drilling, electric utility mergers, rates and resource planning, energy efficiency, and Puerto Rico's electrical system. She has degrees in physics from Princeton and Cambridge. We're also joined by Dennis Wamsted, who has written extensively about the energy transition and utilities. We are recording this presentation, and we will share the slides following the webinar. Cathy is going to present for about 25 minutes, and then we'll take questions at the end using the Q&A function. If we don't get to all the questions, or if there are any questions that are outside of the scope of this webinar, we're happy to follow up offline. So with that, I will share the slides, and we will hand it over to Cathy. Will we?
Okay, great. Thank you so much, Susan, and thank you everyone for being here today, where we're going to be talking about the very hot topic of data centers. As Susan mentioned, IEEFA just put out a report last month looking at how forecasted demand for electricity from data centers is being used to justify a build out of natural gas infrastructure. We looked specifically at the 4 southeastern states of Virginia, North Carolina, South Carolina, and Georgia. And in this webinar, I'm going to walk through some of our key findings. Next slide, please. So first, I'm going to talk about the scale of the infrastructure build out that utilities are talking about in these states so that we're clear on the magnitude of the proposed build out of natural gas power plants and pipelines. Then I'll talk about the underlying load forecast that utilities are generating to justify this infrastructure build out. And then we'll talk about why we think these load forecasts are likely overstated and would likely lead to overbuilding of gas infrastructure. First, by comparing the utility load forecast to independent forecasts of data center demand, and second, by pointing out some of the financial weaknesses of artificial intelligence, or AI, which is one of the major drivers of the growth or the projected growth in data centers. But just because we find that these load forecasts are likely overstated does not mean that environmental and consumer advocates should not be concerned. We'll talk about why regulatory action is needed to make sure that the risk of overbuilding infrastructure is borne by data center developers and not by residents and other customers. And we'll talk about how this data center driven infrastructure build out poses risks for the energy transition on the timescale needed to address climate change. Next slide, please, Susan. So first, the build out of natural gas power plants in the Southeast. Major utilities in Virginia, the Carolinas, and Georgia are planning to build over 20,000 megawatts of natural gas power plants over the next 15 years. And just to give some basis for comparison, 20,000 megawatts is about equal to the total generating capacity of Dominion Virginia Power, the biggest electric utility in Virginia. So we're basically talking about collectively adding a whole new major utility in the Southeast powered by natural gas over the next 15 years. And that estimate of 20,000 megawatts really should be considered an underestimate. For one reason is that Georgia Power has stated a general need for significant additional capacity, over 8,000 megawatts, but has not clarified how much of that would be from natural gas. Probably they will propose a fair amount of that to be from gas. And that estimate also does not include the cooperatives, particularly in Virginia and Georgia, that are also facing demand and investing in new gas power. Next slide, please. So this much new natural gas capacity in the under consideration is also spurring new pipeline construction, including major proposed expansions of the gas pipeline networks in the Southeast, particularly the Transco network. That includes those 4 projects listed there, which include also a possible expansion to the Mountain Valley pipeline. And in addition to that, there's a number of proposals for smaller, more local pipelines and laterals from Transco or other major pipeline systems to specific new natural gas plants. In total, about 75% of the proposed new natural gas pipeline capacity has been justified to the Federal Energy Regulatory Commission based on electric power demand. Although I think it's worth noting here also that electric utilities contract for firm transportation capacity to meet their peak demand day, so that they assure themselves that they will have enough generation capacity and won't fall short of natural gas on the peak day. But on average, across the year, power plants run at much less than 100% of their capacity. And so that means that even though electric utilities have contracted for all this pipeline capacity, they won't be using all of it except on peak days, and they can resell capacity to other users. So this expansion of pipeline capacity also includes the potential for more natural gas export. Next slide, please. So this is a graph of US electricity demand since 1950, and you can kind of see here that basically since the mid-2000s, electricity demand in the US has been essentially flat, and that's been due to a variety of factors, including deindustrialization and energy efficiency. And from the perspective of the energy transition, what that has meant essentially is a one-for-one substitution where an additional gigawatt hour of renewable energy displaces a gigawatt hour of fossil fuel power. But now utility planners are facing a very different landscape. So next slide, please. We're going to walk through a series of graphs here that show just how rapidly utilities have been revising upwards their projections of electricity demand. So this is Georgia Power. You can see from 2025 to 2030 here a very steep increase in electricity demand, and overall, over the next 20 years, 75% increase in demand. Next slide. And this is Santee Cooper, one of the major electricity utilities in South Carolina. And you can see here too, and I should have highlighted this on the last slide as well, the major increase from the 2023 to the 2024 forecast. So utilities have been almost annually or every other year revising upwards their load forecasts over the last couple of years. Next slide. This is Duke Energy Carolinas. The green line there, which is the second to the top one, is the one they ended up using in their resource planning, their most recent resource plan. And so Duke is showing a 25% increase in load by 2038. Next slide. And this is the Dominion zone in Virginia, which includes Dominion Virginia Power and also some electric utilities or electric cooperatives in Virginia. And again, you can see, the bottom line being the 2021 forecast of, kind of a continuation basically of relatively flat electricity demand to the 2024 forecast, which is now showing a 90% or almost a doubling of increase in electricity consumption by 2039. Next slide. And so in the majority of cases that we looked at, the vast majority of this projected growth is being attributed to data centers. In Virginia, Dominion Virginia Power is attributing more than 85% to data centers, Georgia Power 80%, the South Carolina utilities between 65 and 70%. North Carolina, Duke Energy is a bit of an exception, with the utilities stating that about 25% of the forecasted load growth is due to data centers. Next slide. And so this raises the question of whether these Southeast utilities are poised to overbuild infrastructure in response to these forecasts that they've been so rapidly ratcheting upwards over the last couple of years. And so we compared what these utilities are forecasting from data center demand to a forecast from the Electric Power Research Institute, which produced a bottoms-up forecast based more on what data center developers are talking about. And we found that the utility forecasts of demand from data centers by 2030 in Georgia, North Carolina, and South Carolina are between 50 to 300% higher than the highest scenario in the EPRI forecast. Virginia was more aligned with the EPRI forecast, which in some respects is not surprising given that Virginia has more of a history with data centers, and presumably the utilities have a better understanding of how to incorporate data centers into their load forecasts. And this finding aligns with a report put out by Grid Strategies at the end of last year, which looked nationally at aggregate utility forecasts of data center growth and found that the utility forecasts are about 40% higher than tech industry forecasts. And I think it's important to mention here that vertically integrated utilities, such as those found in the Southeast in particular, have an incentive to overbuild infrastructure because they earn a rate of return set by the regulatory commissions in their states. And so it looks like, at least in the case of the Southeast, that these utilities are planning for more data center load than is likely to materialize. And that's before getting into the question, which I'm about to get into, of whether the forecasts from the data center industry itself are reasonable. Next slide. So artificial intelligence is a growing and also a very uncertain component of data center energy demand. Not all data centers are being used for AI. Cloud computing and storage continue to be growing uses of data centers that don't necessarily have to do with AI, but AI is growing as a share of overall data center demand. And estimates vary widely. Between 19 to 32% of data center energy demand could be AI by 2028. But AI, at least as it's been developed here in the United States, is extremely expensive, in large part because it is so energy intensive. The major companies operating in the US that are in the AI space are the major tech companies, Meta, Google, Apple, et cetera, and some privately held pure AI companies like OpenAI and Anthropic that have managed to raise tens or hundreds of billions of dollars to develop and run these large language models. So in terms of like understanding the finances and whether the cost to consumers of AI is covering the cost to develop these models, we look specifically at OpenAI. For the big companies, it's pretty much impossible to tease out from their financial statements specific results with respect to their AI products alone, which is why we focused on OpenAI as a sort of standalone AI company. And basically, OpenAI is spending more than $2 for every dollar that it makes at this point. And in fact, one of the major investors in OpenAI has been Microsoft, who's given OpenAI a deal on cloud computing services. And without that deal, OpenAI's expenses would be significant, like several billion dollars higher in 2024. And so, the costs or the prices charged to customers are clearly, not covering the expenses, mainly the computational expenses and energy expenses of these AI models. And competition is holding prices well below costs. I mean, AI had said at the end of 24 that it was going to start raising its costs or raising its prices and did not do so. And in fact, has significantly slashed prices to developers that lease its models. Um, so for now, investors have been willing to throw a lot of money into these companies to develop AI models, but at some point that will turn around if it becomes clear that these companies are not profitable. And what will that mean for infrastructure commitments once the funding rationalizes for AI? It could well mean that a number of data centers either won't be built or will end up underutilized. And this was, I think, emphasized by the recent news from DeepSeek, which is a Chinese AI model that provoked a fall in tech stocks with its claim that it was able to train its AI model using much less energy and therefore much less of the cost of ChatGPT. And so if that news holds up, then I think it's just further evidence that AI power demand will not materialize to the level that utilities are planning for. Next slide, please. So if we set aside for a moment what I was just talking about, whether utilities are going to overbuild infrastructure, the reality is that electric ratepayers are already partially paying for infrastructure that would not be needed if not for the data centers. One example of this is in high voltage transmission, which typically is paid for by ratepayers across a wide area. In PJM, for example, high voltage transmission is paid for 50% by the customers of the region most directly benefiting from the project and 50% spread across the rest of PJM. And that's the case even for transmission projects that would not be needed if not for data centers. According to Dominion, there are $2.4 billion of transmission projects in the pipeline in Virginia that would not be built if not for the growth in data centers. And again, those costs are being spread across ratepayers in PJM. I think it's also worth mentioning in the context of energy transition that there's limited public tolerance in many cases for new greenfield transmission. There's already seeing a lot of opposition to new transmission projects being proposed to bring power into Virginia. And it's worth questioning whether prioritizing transmission lines for data centers as opposed to, say, renewable energy is going to cause more delays for the energy transition down the line. And the point about cross-subsidization by other ratepayers holds for other electrical infrastructure as well. Utilities build infrastructure that would not be needed if not for the data centers, but part or all of that cost is rolled into the general rate base that all customers pay for. The Virginia legislature found that Virginia residential rates will go up by $14 to $37 per month by 2040 because of the infrastructure to serve data centers. This risk of cost shifting from data centers to the rest of ratepayers is just exacerbated by the prospect of utilities overbuilding infrastructure. So that is to say, ratepayers will be even more on the hook to pay off infrastructure if a major data center customer doesn't materialize or doesn't end up using as much power as they said they would, and the utility had, built infrastructure assuming a certain amount of power demand that ends up not being there. So utility regulators are, I think, starting to pay attention to these risks, and there have been a few examples of contracts that try to push some risk back onto data centers by requiring the data centers to commit, for example, to purchasing a certain amount of electricity over a certain amount of time, if they end up not needing that amount. There's also another report that came out around the same time as ours on rate design for data centers from Energy Futures Group, pointing out sort of best practices and how to ensure that data center customers are not pushing costs and risks off onto other customers. And finally, I think it's worth pointing out that even proposals for co-location, which is where a data center builds right next to an existing or a new power plant and draws power directly from that plant, those proposals still raise costs about imposing new costs onto other customers. And that's because in many cases, these facilities are still connected to the grid. And so grid planners still need to figure out how to supply the data center load if the power plant has an outage, or conversely, how to manage a sudden influx of power onto their system if the data center goes out and the power plant is still producing. So there are still a lot of cross-subsidization issues to be worked out around co-location. Next slide. And finally, I want to talk briefly about the risk to the energy transition posed by data center demand growth and utility overbuilding. First, there's, I think, the obvious problem of a major build out of natural gas infrastructure and a 30+ year commitment to gas-fired power plant capacity at a time where all this scientific evidence is the need to rapidly reduce emissions in order to not miss important climate targets. And then I think there's also the question of whether the investment in electrical infrastructure to serve data centers, even if it is renewable energy, is going to crowd out investments that are a higher priority for the energy transition. That is, if they're whether or not we should be prioritizing serving new electrification loads and electric vehicle manufacturing, and which also create more economic development than data centers, which are questions that are clearly not being asked at the moment. But I think it is safe to say that the rush to build data centers and the new natural gas plants that are coming with it are taking us in the wrong direction with respect to the energy transition. Next slide. So in short, the key findings of our report are, first of all, that the Southeast utilities that we looked at are planning a major build out of natural gas infrastructure that they are largely justifying based on data center demand. These utilities are very likely to overbuild natural gas infrastructure. And this planned build out puts ratepayers at risk and also marks a major step backwards for the energy transition. Next slide. Yeah, I think that's it. Happy to answer questions via email later for folks that are watching this on the recording, or if other questions occur after the webinar.
Great. Thank you so much, Cathy. I encourage everyone who has any questions for Cathy or for Dennis to put them in the Q&A function. I see a couple are popping up already. We have one. This is an easy one. Go back to the key takeaway slides. There we are. So our first question is from John Jacobs. How do capacity markets operate? Will grid operators be unable to control the level of new development through capacity auctions?
Welcome, Dennis, to jump in on that as well. I mean, I think the different grid operators operate have slightly different rules for their capacity markets, but generally these are, looking out several years ahead and trying to put a price to incentivize the development of new capacity, which has not necessarily worked as well, I would argue, as have been hoped for in some markets. But I think in PJM, for example, we saw the growth, the forecast of growth in the PJM Dominion zone. PJM has very much been worrying for the last couple of years about potential future capacity shortages over its planning horizon. And I think it's not just a question about whether the capacity markets can attract sufficient new capacity, but also questions about planning new transmission lines to get capacity connected to load. For example, and again, sticking with PJM for a moment, there are several high voltage transmission projects planned across Maryland and across West Virginia to supply power to data centers in Virginia. And I think there's an open question about whether those projects are going to be developed on the scale that, or on the time frame that PJM has said would be necessary to meet the load growth that they're projecting. So in other words, it's not just the capacity markets that would need to respond here. I don't know if Dennis has an additional response on that.
No, I think you did a good job on that, Kathy. I mean, capacity markets are very much like insurance in my view. You are having companies bid in to be available when they're needed. And so the operator of any particular grid, and we talk about PJM here because that's where Dominion, Virginia is, but the operator of the grid bids in how much or asks for bids for how much capacity they think they're going to need in that out year period, 2 or 3 years out in the future. And this we went through a 10-year period of time when there was excess capacity in PJM, and so capacity markets were very low. They were in the 20, 30, $50 a megawatt range. And now with a looming potential shortage of capacity, they've gone very, very high, which is designed to encourage people to build into the market and then bring down prices. But capacity markets are a webinar in and of themselves, or maybe a whole series of webinars. But we would be happy to talk about that in more depth via email or a separate phone conversation.
Great, thank you both. Next question is from Mike Carberry. We have seen many utilities mention using small modular reactors, SMRs, or reopening closed nuclear plants to meet future data growth. Did you research that angle?
No, because, well, mainly for the utilities that we were talking about in the Southeast, the bulk of the build out that have been talking about is natural gas. But I know that Dennis has sort of separately done research on small modular reactors, if you want to say anything about that, Dennis.
I would love to jump into that question. We have done a lot of research on the mismatch in timing between the projected demand growth for data centers and AI, which is very much front loaded for the next 5 years, 6 years. And then there is the other side of the coin where a SMR may be built by 2032 in the United States, one SMR. Not anywhere near the capacity that's needed by data center folks or AI folks. They are investing in a potential future that might start to get built out in 2035. We still have very major questions and concerns about the costs of SMRs and for the large AP1000s, but it's not an answer for the next 5, 6 years in any stretch of the imagination.
Great, thank you, Dennis. And I did put a link to some of our SMR work in the chat so people can look at that on their free time. Next question is from Brad Plummer. I know your report is focused on Virginia, South Carolina, North Carolina, and Georgia, but is the risk of overbuilding likely to be as big a concern in other parts of the country? Is it most acute in the Southeast because of the structure of markets and utility regulation there, or are there risks in other types of markets? Thank you.
I would say yes, in the sense that the Southeast utilities being fully regulated, vertically integrated utilities do have a higher risk of overbuilding. And if we go back a few slides, Susan, sorry, keep going backwards a few. Yeah, that one. What we found in comparing to the EPRI data was, a higher level of overbuilding, particularly in the Southeast, than what a more national level survey found. But that said, the financial weaknesses of AI and the questions about whether all these data center projects are going to come to fruition, or whether there's some elements of a sort of financial bubble in the AI space that is a broader risk that doesn't have anything to do with the Southeast in particular.
Thanks, Kathy. Next question is from Greg Leroy. Please say more about AI industry financial losses. Who are the best sources you watch analyzing those?
So because these sort of pure play AI companies like OpenAI and Anthropic are privately held, it's harder to get detailed financial information. The financial information that that was formed sort of the basis of that section of the paper was from information that OpenAI had given to its investors when it was in a major fundraising round back in September of last year, and that was also reported in the New York Times. But in terms of uh, sort of ongoing aggregate, I don't know that I have not found a particular source in a sort of ongoing way other than just, looking for what periodically comes out in tech industry publications that give some indication of financial positions.
Thank you, Cathy. And I'll just put your email address back up
Yeah.
again too if we have any follow-ups from that. Next up is Lexi Doherty. A report from Duke just came out rethinking load growth in US power systems. Have you dug into how utilities may be able to handle increased load by balancing demand across markets? Would that be harder in the Southeast?
I mean, that was not a focus of this report. I mean, I think uh, I would say that there is generally, again, like a sort of fundamental economic contradiction with utilities sort of wanting to build more infrastructure, particularly in the Southeast. It is sort of always been challenging, as many folks know, to get utilities to implement at a greater scale sort of energy efficiency and demand response and other types of uh, programs that could sort of mitigate load growth or mitigate the need for new physical infrastructure to deal with load growth. But yeah, that said, I mean, I'm not aware of the specific study that you're referring to, but definitely would be interested in taking a look at it. I don't know, Dennis, if you have further thoughts on that too. I
Um,
mean, Dennis, feel free to jump in at any time.
no, I will jump in when I have things I think might add to the conversation. But that study actually is worth everybody reading. It was put out this week by the Duke, I believe it's the Nicholas Center on Environment. A couple of guys or a couple of researchers there who I follow pretty closely. They've done a really good job of showing that demand flexibility could be a huge win for everybody going forward. Talking about mitigating the need that Cathy brought up in the presentation about how you purchase for your peak demand day, and that's what people are building for, this peak when everything is running at 100%. If we have a little bit of flexibility, 1%, 2%, you mitigate the need for a lot of that extra capacity because the peak is very small in timing, but very high in the amount of capacity needed. So it is definitely, I will be happy. I don't have it handy on my screen, but I'd be happy to send the link to anybody who wants it. It's a really good report, and it's something that we should be talking about more in the space as we go forward, because it would allow us to meet this new demand with less generation, without a doubt.
Thank you both. Maybe we can include that in the follow-up materials
Yeah.
so people can take a look. Next question is from Jem Bengal. Many data center companies appear to be moving toward on-site power right now, Tier 4 generators and natural gas turbines, which would seem to add to the issue of overbuilding. Not really a question, but I don't know if you looked into that at all, Cathy.
Yeah, I mean, I think I think it goes into one of the things I didn't address in detail, but one of the reasons I think we're seeing that utilities are um, sort of coming up with load forecasts that are greater than sort of the aggregate data center industry forecasts is precisely this sort of double counting issue of um, utility gets approached by a data center that's shopping for a location and may talk to several different utilities, and then that one data center, although it's obviously only going to choose to finally be in one place, may get picked up in load forecasts of multiple utilities. And I think what that comment referenced is a similar idea of like a data center that may uh, end up deciding to go with its own sort of separate power provider instead of the utility.
I have a slightly different take on that comment. It wasn't a specific question, but I think that the data center people who are considering going off the grid with their own generation or hiring a company to build their own generation and being unconnected to the grid are going to find out it's not nearly as easy as they think it is, and it's going to be much more costly than they think it is. Because if you have
And it's going to take longer than they might be thinking too.
right, if you have pick your size, 100 megawatt data center, 250 megawatt data center, you if you're off the grid, you have to have your primary generator, which is supposedly supplying you 90% of the time. But then there are times when you're down for maintenance or when it has to go offline or goes offline unexpectedly. So you have to have exactly that same amount of capacity available in reserve. Because if you are off the meter or behind the meter, you are literally not connected to the grid. So it's more costly than is being advertised in the sort of general media and the data center press releases. And it's a lot harder than it seems to be.
Great, thank you both. Our next question comes from Tanya Bonita Tibis. I am curious if you have come across any good websites or descriptions of the different types of data centers. There is a lot of confusion about the different types and what they are for.
Yeah, I mean, I think there's like, I'm gonna be happy to follow up with you, Tanya, after this call too. But I mean, I think in broad strokes, there have been movements over the last decade from sort of like companies moving from sort of smaller, like in-house corporate data centers to much larger hyperscaler facilities. And that's actually like one of the reasons why US demand growth was relatively flat over the last decade or so, despite a major growth in data centers, was the sort of efficiency of moving away from smaller data centers into larger facilities. But and then there's also sort of uh, different models of data center development in terms of like who is building the data centers. Some of them are obviously being built by the major tech companies like Meta or Google or what have you. But then there's also a lot of companies that are just more in the real estate development space, commercial real estate, that are building the shell and then like leasing to a data center company.
Great. Next question is from Keaton Peters. Do you have any thoughts on, or did you look at the role state and local financial incentives are playing, such as tax incentives for data centers to move in or taxpayer funds devoted to grid infrastructure and benefiting power plants?
So we did not specifically look at state tax break infrastructure. We really focused on solely on the electric utility side of things, which in some cases has included like special rates for data centers. But I know that, in fact, Greg Leroy from Good Jobs First, who is on this webinar, his organization has done a lot of work looking at state tax breaks to incentivize data centers to locate in specific areas. And so if anyone wants to follow up with me afterward, I would be happy to send some of the work that I'm aware of on that issue.
Great. Next question is from Nancy LaPlaca. What do you think the best arguments are to address the high data center build out in order of priority? What about Google's idea to locate data centers near high renewable energy sites?
So I think it's very like situation specific, which may not be the answer you want to hear. But I think because I think the local concerns are very different depending on the situation and whether the data center, for example, is going to be uh, powered by natural gas or whether it's trying to build its own natural gas plant, which can be complicated for the reasons that Dennis had mentioned earlier. Um, Locally, there in many cases have been a lot of concerns about the water consumption of data centers, which is something that we did not get into at all in this report, but is very much a serious issue in certain jurisdictions. And then also just the cost subsidy or the cost transfer issue, which again, depending on how active the regulator is in trying to prevent cost shifting, sort of determines how big a risk it is that utility customers, residential ratepayers are going to end up paying for a bunch of infrastructure that is basically only serving the data center demand.
And yeah, I'd like to add I'm not quite sure I understood the question 100%, but our argument if you're talking about priorities would be especially in areas in the Southeast, which has been traditionally very utility friendly, and when the utility says I need to build something, the regulators tend to say, okay, go ahead and build it. The argument that needs to be heard by the regulators is that renewable energy is quicker and cheaper to build. We have the ability to quickly build all sorts of solar and battery storage in the 12 to 24-month time period. And right now, if you were to go to your regulator and say, I want to build a gas plant, if you haven't already ordered that turbine, it's not going to be built for 4 or 5 years. And so if there's a priority setting going on here, we should be building as much renewable energy and as much battery storage wherever there are these data centers. And then if in 5 years we haven't built enough, well, we can build some more renewables and then maybe talk about adding gas to the system. We've turned the system upside down here in the Southeast where it's go gas first. And if we can build renewables later, we will. But it really should be renewables first and gas down the road. They're quicker and they're cheaper.
Thank you, Dennis. Next question is from Sarah Barzak. Can you please comment further on the return on equity incentive that these utilities have to overbuild, essentially? Especially interested in Georgia Power, given their 11.9% ROE, which is high, approved by the Georgia PSC. Did you have a slide on this, Cathy?
I didn't specifically. But yeah, I mean, regulated utilities are able to put into rates for recovery from ratepayers any costs that the Public Service Commission, the regulator, deems to be a prudently incurred cost. And they get a return on investment that is approved by the regulatory commission for capital investments that they make. And so, which, is basically set to recover the return on any, or, interest on loans, the cost of debt to the utility, and the return on equity or the profit to the utility company. And so, distinct from a generator that's operating in a private market and doesn't know what the price of power is going to be, and so doesn't have like a clear sort of guaranteed rate of return on its investment. The utilities that are in the regulated markets do have a guaranteed return on their investment as long as the utility commission has approved the investment as a prudent expense, which is basically always the case, or otherwise the utility wouldn't be building it. Although there are some exceptions for extreme cost overruns and things like that. But generally speaking, utilities want to build infrastructure if they know that they're going to get a certain rate of return that's recovered from ratepayers.
Great, thank you, Kathy. The next question, not a question, but some information from Shelley Robbins. The Southern Alliance for Clean Energy has a paper coming out in the next few days that will talk more about the LNG export connection to all of this. So I think that will be interesting for many people on the audience, including IEEFA ourselves. We love talking about LNG. Next
Right. Well,
question.
not just a comment on the comment. Um, we have said at IEEFA that LNG exports are likely to lead to an increase in gas prices in the United States for domestic customers. And obviously, if you have a large gas build out in these southeastern states and elsewhere, they're going to be using gas. And if it's more expensive gas, that means you're going to be paying more. So there definitely is a connection there.
Great, thank you. Next question is from Lexi Doherty. And she specifies that this might be a little bit outside of what you researched here, but are data centers focused on lowering energy demand at all? My understanding is cooling can be a big part of demand. I would assume, especially in climates like the southeastern United States, thinking specifically that shallow geothermal heat pumps could be a great option for future builds. I don't know if either of you can speak to that at this point.
I think on the cooling demand, that's a little outside the scope of what I was looking at. I don't know if Dennis has looked into that.
Not much, except that they are trying to a lot increasingly they're going to water cooling as opposed to AC or just natural ventilation kind of cooling. But um, the the takeaway there is that data center folks haven't had to worry about their energy consumption up till now. And if you're an optimist, you would say, well, if that's increasingly going to be a problem, they're going to figure out ways to lower it going forward. Um, I'm not sure if I totally am optimistic about that or not, but they are definitely looking at the problem now more than they were 5 years ago, for sure, because energy is now a roadblock for them, and they need to figure out ways to get around that. So improving their efficiency or lowering their demand is certainly, or certainly two of the options for them.
Great, thank you. Our next question, um, from your research, do you think government research and development supports to help innovate the energy efficiency of data centers would be an important consideration for tech companies seeking to develop one in a few different jurisdictions? Would this help the ratepayer as well and the company's operations, and would the temperate climates factor into the decision? So similar to the last question, energy efficiency, how does that play into this?
I think that, I don't know that I have much to add to this beyond what Dennis said on the previous question. I think like the tech industry right now is pretty well incentivized itself to pursue energy efficiency uh, because of the cost that energy is imposing on them, not only in terms of the financial cost, but also just like the difficulty of securing power supplies.
Great. And if anyone, has a follow-up question, please feel free to reach out. We can dive into anything more with you. We don't have any other questions at the moment. Oh, here comes one. I knew people would be ready to go. Dave Arndt is asking, have you done any research on how and when we can eliminate diesel generators? I don't know that that's what you looked into with this paper.
No, we did not look into that specifically, but I know that that is certainly a concern with a lot of data centers using diesel generation as backup. And I think that that has been at play in different like state regulatory decisions about how much because of the air pollution from diesel generators, essentially how much diesel backup generation to permit. But that is not something that we particularly looked into in the course of this report.
Sounds good. We can wait a minute or two if anyone has any additional questions, but right now we have answered all of them. I can stop sharing for the moment. Okay, it looks like we've answered everyone's questions. I don't know if Cathy or Dennis have any last minute thoughts they'd like to share with everyone. And just a reminder, we will be sending this information around later. But I think we have gone through anyone. Cathy, do you have any last words of wisdom to leave us with?
I don't think so. I mean, appreciate everyone being here for all the interest in the topic. It's certainly one that it's not going to be going away for the next several years. Oh, Susan, someone just asked for the
Oh,
link to the
yes,
report in the chat.
absolutely.
But yeah, and then again, feel free to follow up with me or Dennis via email if you have additional questions.
I have too many tabs open, or I would have had this handier. Let's see, chat. Okay, great. So the link to the report is in the chat. I don't see any other questions except for a thank you to everyone. So thank you to all of you for joining us today. We will send this around in the coming days, and we encourage you to stay tuned to the other work that we're working on at IEEFA. And thank you again to everyone. Thank you to our presenters, and have a good rest of your day.